the market posting somewhat of a gain yesterday. We saw it gain 0.1% last week. How are you reading the market's picture at this point in time?
Good morning, Samantha. The market has really shown some resilience in spite of the downward trend. What I think is happening now is a stabilizing of sorts, because we did expect the market to be doing much worse by this time in October. As we move towards December, I think we'll see some more decline, especially in equity turnover. We'll also see some major counters losing quite a bit. If you look at the Nairobi Securities Exchange, most of the sectors listed are trading at fair value PE ratios, and most are trading, many are also trading below that value. So moving on in the next few months, maybe next 3 months, I expect a further decline.
So you're bearish on the markets at this point in time, not expecting a correction anytime soon, worrying for the equity market, which has really been battered this year.
Yes, because you have to take such a position, especially when all the fundamentals point that way. I would like to be the one showing all the optimism, but right now we have inflation problem, we have currency problem, we have a myriad of other factors which come into play, like political risk, and we also have political uncertainty. And most of the industries which gain us a lot of revenue are also under risk. We have tourism being one of the major foreign exchange earners. At a time where we move to elections, tourism declines because foreigners are averse to the political climate. So looking on, I think there are more red flags than we would like to see.
One pocket of good news is that sugar producers in Kenya will be protected for another 2 years by the import safeguards. When we're looking at Mumias and their cost structuring at this point in time, costs are set to increase. They've increased their wages to employees by around 9%, by a fifth rather. When you're looking at that company, how efficient is it, and how is it managing its costs?
I would put it at, I would say it's fair. Their management is fair. They still have a lot to do in terms of streamlining their expenses. They still have a lot to do in terms of maximizing on what they can get from the business they do, which is sugar. But looking on, also looking at the COMESA, if in effect soon, we have them in a tight spot, but all the same, I still think they have a lot they can do for the company, and they still have a lot of room for growth.
Where's the room for growth? Is it in the sugar industry, or is it outside of the sugar industry? They have been diversifying their revenue streams.
I would put it into maybe three or so major ways. The first being streamlining what they already have, and that's the sugar production. The second may be perhaps to focus on the ethanol production, which they've already received funding for. That could be another alternative source of revenue for them. And the third, perhaps, is what they already began a couple of years ago, and that's the cogeneration plant, of which they use bagasse and other byproducts to produce electricity and subsequently sell to Kenya Power and Lighting. So I think they should maximize on these three modes of operation, and I think that's where they would find room for growth.
Now, stock that one would ask whether it has much further to fall is Access Kenya, down more than 60% for 2011, really being punished by the market with concerns over its market share going forward, as we have larger IT players really vying for the data space. But Kestrel Capital initiated a buy rating on that stock. What are your projections for the full year earnings for the company? They see a recovery in margins, they see a recovery in earnings, and a return to a stronger profitability.
Based on the facts, I would agree with them, and I would bet on them, because we had them do that. We had them recover in the year ended in February. I think the year ends in February 2011. So I think looking forward, they already proved they can recover. I think over the period, over the months, they have been doing a lot to ensure that recovery is sustainable. So I would put my chips on the table with Access Kenya. Other than that, the ICT industry is challenging. The competition is really stiff. But then again, as an investor, if you look at the stock at 4 shillings, that is really a discounted value.
Just looking too cheap to not put some cash into that at this point. Where else would you be putting your money if you were to invest in the equity market? You say we still have further to go down for 2011. Which stocks are safe bets?
Right now, I would stick to my original best stocks, that being the financial sector stocks, being the commercial banks. For example, if we were to look at Barclays, it's only trading 2 shillings away from its a 1-year low, trading at a trailing PE of 6.02, which is about 2 below the sector PE. Very cheap stock, a lot of room for growth. We have the third quarter results expected out in November. I would put my money there. Other than that, I would also look at the agricultural stocks. They're really having a field day with the weakening shilling because they rely on exports, getting a lot of foreign currency denominated revenues from that.
So banks and agricultural sector stocks. Robert, thanks for your time this morning. Robert Munuku, a dealer and analyst at Drummond and Co.